There he
Hi
is.
there, Jimmy.
Erik, how you doing? Good to see you.
Great. Good to see you too.
Yeah, this is becoming routine, isn't it?
It is. It's very. It's a lot of fun doing this presentation.
Good. Well, you're a long time OZ Pitch Day partner with us, so we appreciate that.
All right. So here at Urban Catalyst, we're raising money in our second fund. It's structured as a pretty traditional real estate equity fund. It's focused on doing ground up real estate development projects in downtown San Jose. And it's also an opportunity zone fund, and that allows us to give the opportunity zone tax benefits to our investors. Just to kick us off, we've been featured pretty prominently in the news here in San Jose over the last few years. We've had over 200 news articles written about us. Really, just a lot of positive buzz about what we're doing here in downtown San Jose. Probably most important of these, we were named by Forbes magazine as one of the top 20 opportunity zone funds in the country. So there's nothing like getting a little national validation from Forbes that we're doing things the right way. So a little bit about the program itself. In order to get the tax benefits, you have to have a capital gains event. Here are the three most common ways that folks have capital gains events. It's interesting here at Urban Catalyst, the sale of stock. That's our most common way that our investors have capital gains event. Over 70% of our investors, that was their event. It makes a lot of sense. Folks have never really had a way to shelter paying those taxes from the sale of stock before opportunity zone funds were created. And now that they have that safe harbor, they're really looking into our program. So if you have a capital gains event and it has happened in the last 180 days and you invest into an opportunity zone fund, that's how you get those tax benefits. We throw this 180-day slide up here just to remind everyone so no one's caught off guard. You have 180 days from that event to invest. And then if you do invest, there are three primary tax benefits that you get from the program. The first is you're able to defer paying taxes on that initial capital gains event until you pay your taxes in 2027. The second is when you pay your taxes in 2027, you get a 10% reduction. So for every $100 that you would have owed in taxes, you only have to pay $90. And these are great, but it's really the third benefit that is the biggest benefit, and that is after an investor's money seasons in our fund for 10 years, all of the profits from the fund itself are tax-free from a federal capital gains perspective. So everyone likes tax-free profits. Here at Urban Catalyst, our plan is to build these buildings, lease them up, stabilize them, wait till we get to that 10-year mark, then sell the assets and liquidate the fund. And that's when we return the majority of the profits to our investors. Also, one last thing to mention, and this 10% reduction right here, that goes away at the end of this year. So anyone out there that is interested in investing into opportunity zone funds, definitely this is the year before that second benefit goes away. A little bit of history on the program itself. It was created as a part of the 2017 Tax Cuts and Jobs Act. And when it came out, the IRS and the Treasury said they were going to do 3 rounds of clarifications. Here are the dates that those 3 rounds came out. We had our attorneys put together how clear they thought the program was after each round. You can see the percentages here. And really the meaning of this is the program wasn't 100% finalized until December of 2019, but now it is final. Over here on the right-hand side, this is investments into opportunity zone funds across the country. You can see before those April guidelines came out, almost no investment. Once the December guidelines came out, the final ones, you can see that increase in investment velocity. So now we've got a clear program, which is great. Taking a little bit of a step back, here are the opportunity zones in the San Francisco Bay Area. For this fund, obviously, we're focused on San Jose and even more specifically downtown San Jose. You can see that there are 4 opportunity zones that cover almost all of downtown. And it's interesting, when I formed Urban Catalyst, my plan was to create a real estate equity fund focused on doing ground up development projects in downtown San Jose. And that was because it's really all about the macroeconomic trends throughout Silicon Valley, all pointing towards downtown as the next place to do development on a large scale. And it was only after I started forming Urban Catalyst that I learned about the Opportunity Zone program, and that everywhere that I was planning on building these buildings was already located really in the zone. I thought, well, would it be nice to be able to give my investors these additional tax benefits associated with this program? So that's how we became an Opportunity Zone fund. And when I talk about the macroeconomic trends in Silicon Valley, I'm really talking about tech migration. I mean, here are a bunch of the big tech companies located in Silicon Valley. I mean, everybody knows lots of tech in the Valley. For this specific example, I'm going to talk about one of the 5 largest companies in America by market cap. 3 of them have their headquarters here in the Valley, which is Facebook, Google, and Apple. And really, as these companies have just grown to be enormous over like the last 20 years, they've expanded their office footprints, all over the world, all over the country. But here in the Valley, we've seen a slow migration southward. If Palo Alto and Mountain View are kind of the centers of the technology universe, they're not very big cities. So we've seen, especially in the last 10 years, a huge migration into the city of Sunnyvale. To give everyone an idea of kind of the scale of this, currently here in the city of Mountain View, Google occupies 95% of the office space in the entire city. Here in the city of Cupertino, very similar, Apple occupies 85% of the office space. And now in the city of Sunnyvale, Google and Apple combined have more than 50% of the office space. Sunnyvale has been really the beneficiary of this recently. I mean, gangbusters development has been happening for 10 plus years, and now the city's almost completely built out. And it was interesting when I first started Urban Catalyst, I'd show this slide and I'd say, and where will these companies continue to go? Now there's no space left in Sunnyvale. And the answer is downtown San Jose. But now I can just say, and all of these companies have moved into San Jose because Microsoft and Apple have taken large land holdings in San Jose. Amazon has an office here downtown. And really the big story has been Google. And we'll talk a little bit more about that. But because of this tech migration, we've seen office rents in downtown San Jose more than double in the last decade. And at the same time, we've seen vacancy rates that downtown hovered between 20 and 25% for decades now drop down below 10%. Now, here at Urban Catalyst, we're not just fund managers, but we're also the developers of all of our projects. And we've done development all over the Bay Area. 3 things that we want to see when we do development anywhere, and downtown San Jose has all 3. The first is we want to make sure there's a demand for all of the different types of projects that we're building. That demand in downtown is really driven by the Silicon Valley job engine. We want to see transit and physical infrastructure already in place. Downtown San Jose really is the only true urban environment in Silicon Valley. Diridon Station, slated to be the largest train station on the West Coast, has a variety of mass transit options that connect to it, including Caltrain, which can get you to San Francisco in about an hour. And now BART, which is fully funded to connect through downtown into Diridon Station. And for those of you that don't know, BART is the largest mass transportation system here in the Bay. It circles the entire Bay. And of course, last but not least, San Jose State University, right in the heart of downtown with 35,000 students. It's the 2nd largest university in the Bay Area behind Cal Berkeley. We also want to do business in a place where the local government wants to see development happen. That is not the case in most Bay Area cities, but it's absolutely the case here downtown. This is a picture of my partner, Josh, and I with Sam Liccardo, the mayor of San Jose. He's been the mayor for 7 years, and before that, he was the council member representing downtown for 8 years. And it's really the policies that he's put into place that have streamlined the pre-construction process and just made it so much easier for developers like us to do business in the downtown core. To give everyone an idea of just the massive revitalization that's occurring here in downtown, I want to show this before and after slide. This is the current skyline of San Jose. If all of the projects that are currently in the planning process are built out, say over the next 10 years, downtown San Jose should triple in size. You can see Urban Catalyst Fund 1 and Fund 2 projects in red. Here's my 2-dimensional map to keep talking about the San Jose real estate market. This black line, this represents the opportunity zone. Our headquarters is right here. So Urban Catalyst, we're located right in the heart of the zone. We're right next to Adobe's world headquarters and Zoom's world headquarters. Here's San Jose State University. This red dash line, this is where that new BART line is going to run underneath Santa Clara Street. It's got a station downtown and then connects into Diridon Station, that big train station. And as I mentioned, The big story over the last couple of years in downtown San Jose has been Google's massive amount of acquisitions. To give you guys the cliff notes, in the last 5 years, Google has spent almost $500 million on land acquisition. They've acquired over 80 acres of property, and the plans that they had approved at City Council earlier this year show them building roughly 7 million square feet of office and 6,000 residential units. At build out, this will be Google's largest campus on earth. So it's pretty exciting stuff. But of course, Google's not the only story in town. We've also seen a lot of really big developers flood into the downtown in recent years. 3 notable ones: Boston Properties, J. Paul, and West Bank. Combined, these 3 groups have spent over $1 billion acquiring property. They're planning on doing millions of square feet of new product here in the downtown. To give everyone an idea of some of the really cool architecture that these groups are planning on, to show this slide so you can see some of their renderings. But here at Urban Catalyst, we saw this wave of development coming to downtown. We started in 2018, and it was obvious that this was happening. And our plan was to really get in on the ground floor and acquire properties before they were scooped up by all the other big developers and big tech companies. And that's exactly what we did with the acquisition of our Fund 1 and Fund 2 projects. Here you can see our Fund 1 projects in blue. 6 projects in Fund 1. As Jimmy mentioned, we raised $131 million in Fund 1. We raised money for 2 years. We closed fundraising for that fund in December of last year. Here's what those 6 projects look like. A variety of different asset classes. We started construction on Paseo earlier this year, and we plan on starting construction on all of these projects in the next 10 months. The next projects that will start are Madera, Keystone, and Delmas. Paseo and Fountain Alley, these are both 100,000 square foot mixed use office buildings. The Keystone is a 175 key extended stay business hotel. It's a Marriott Town Place Suites. Delmas, this is a senior living facility. Madera is an apartment project. And then the Mark is an 800 bed student housing high rise. So these were our projects in Fund 1. But of course, today we're here to talk about Fund 2. Fund 2 is located right here in Orange. It's just a fantastic location for new development. You can see we managed to acquire almost half of an entire downtown San Jose city block. And it's right on Santa Clara Street. Santa Clara is really the main drag of the central business district. It's across the street from City Hall. It's right next to that future BART station. So really the epitome of transit-oriented development. We really like this location. And this is what Fund 2 looks like. Fund 2 is 2 buildings, Icon and Echo. Icon there on the left is a 420,000 square foot office building. And Echo on the right, that's a 300 unit multifamily project. These are the 2 projects that are in Fund 2. Here's a different view of the projects. And when I talk about these projects, what I like to talk about is the demand. Why did we choose to build these type of buildings in this location? First, I'll talk about multifamily demand. And this is kind of a no-brainer. Here in California, we have what's called a housing crisis. It's especially true here in Silicon Valley, where we've created 6 jobs for every housing unit that we've built for over 30 years straight. And that has caused us to have some of the most expensive housing, both for sale and for rent, in the entire country. We literally can't build multifamily fast enough to meet the demand. Interesting statistic that recently came out. If we wanted to build enough housing here in Silicon Valley to have an equilibrium of supply and demand, we'd have to build around 150,000 housing units. We've never built more than 5,000 housing units in a single year in history. That's why I say we are going to have a real hard time building our way out of this. Whenever we build multifamily here at Urban Catalyst, we like to put in a lot of just fantastic amenities for our tenants. This is our 8th floor podium deck. We have an infinity pool. You can see these cabanas. This is a 2-story amenity space that wraps the podium deck with an indoor-outdoor fitness facility. This has, of course, a dining room, lounge area, movie room, game room. And then out here on the grass, we have some barbecue areas. Up on the 27th floor, this is our rooftop lounge, really to take advantage of those views from the top of the building. Also on the interior here, this is our office space for our residents. And this is the conference room. Of course, it doubles as a dining room in the evening. So that is the Echo project, our multifamily. And this is Icon. Icon is our office portion. And the difference in demand between multifamily and office here in Silicon Valley is there's still a strong demand for office. It's just that developers here in the Valley, we can build office fast enough to meet the demand. So whenever we build new office, we know we're going to be competing for those top quality tenants. And there are certain aspects of the project that are must-haves in order to be successful. And this project, of course, has all of those things, or else we wouldn't be doing it. The first is, the old mantra, location, location, location. We talked about the project's fantastic location in the downtown core of San Jose, but San Jose competes with all of Silicon Valley when it comes to the office market. And so how does downtown San Jose compete? And it really competes because it's one of the only places you can get space at scale because there's room to build larger projects. And rents are around 50% of what they are in the city of, say, Palo Alto. So you can get space more cost effectively. Second thing that we want to see is what I call functionality. Functionality means that we have the right amount of parking, which we have for this building. We have these huge floor plates, so it's almost 40,000 square feet per floor. I mean, that's almost an acre of net square footage per floor. That's really what all the big tech companies want to see these days. They call them the big fat boy floor plates. We also have 14-foot floor-to-floor heights, so we have that open, airy office feeling. And we utilize a lot of indoor-outdoor space to really take advantage of the 300 days a year of sunshine that we have here in San Jose. You can see some of our exterior staircases, balconies, and back in this rendering, you can see some of the rooftop decks that we're putting onto our buildings. And then the last thing that we have to have when it comes to new office is what I call architectural aesthetic beauty. We have to have a good looking project. For this project, we're utilizing WR&S as our architect. They're one of the premier architects for new office in Silicon Valley. They just finished doing Microsoft's campus up in Mountain View, and they have designed this project. I'm really pleased with how the design has turned out. So those are the two projects in Fund 2. What makes Urban Catalyst different than other opportunity zone funds is, we're not just fund managers, we're also the developers. Most other fund managers, that's what they are, they're fund managers. Their plan is to go out, raise a ton of money and look all over the country to find developers that have projects located in opportunity zones. Of course, here in the Valley, we look at Steve Jobs and Steve Wozniak and we think, did these guys go out, raise a bunch of money and then hire someone to build them a computer? The answer is no, of course not. They built a computer and then they took it out to the market. And that's exactly what we're doing here at Urban Catalyst. We are the developers of all of our projects, and we have projects in our portfolio, and now we're taking them out to the market. Another thing that's important that I like to talk about with any potential investor is, when you hear about opportunity zone funds, the first thing you hear about is the tax benefits. And, don't get me wrong, we got great tax benefits associated with the program, but if the biggest tax benefit that you're getting is you're getting tax-free profits after 10 years, there better be profits after 10 years, or really what's the point of the entire program? So understanding the overall real estate market, the asset classes that are being built, and who the developers are that are building the projects, that really matters. Here at Urban Catalyst, we see ourselves as a solid fundamental real estate equity fund and ground up development company. And we see the opportunity zone tax benefits really as just the icing on the cake for our investors. A little bit about me, I'm the founder. I've been a developer my entire career. I've done several $1 billion worth of projects here in the Bay Area. In general, I build institutional quality and scale projects. Really what that means, I build large income producing assets. Typical exit strategy is to sell to a publicly traded REIT or a large institutional equity group. There are 5 partners in total at Urban Catalyst. So when I first started Urban Catalyst, I knew we'd be doing ground up development in downtown San Jose. So really wanted to build an all-star team of downtown San Jose developers. And I did that by bringing on Josh Burrows and Paul Ring. I've known both Josh and Paul for over a decade. Josh is our Chief Operating Officer. For 9 years before he joined Urban Catalyst, he was the lead developer at Barry Swenson Builder. They have a massive downtown San Jose portfolio of properties, and Josh managed that entire portfolio. He did a lot of ground up development, his experience building a variety of different asset classes and project types. Paul Ring, for 15 years before he joined Urban Catalyst, Paul was the lead developer at the core companies focused on multifamily and below market rate housing here in the downtown core. Paul, I had the unique experience of working as a joint venture partner with Paul about a decade ago on 2 apartment buildings here in San Jose, and really liked Paul's style. So we brought him on as a partner, and he manages our 15-person team of development and construction professionals that build all of our buildings. Of course, we're not just developers, we're also fund managers. Morgan Mackles. Morgan is a very close friend of mine. We've been friends since we were in high school, so we've known each other for 25 plus years. Morgan has spent his career building scalable and repeatable sales processes. He's done it for big and small companies, Fortune 500 all the way down to startups. And he's the primary reason why we are so successful, or we're so successful in our Fund 1 fundraise, and why we're off to such a great start here in Fund 2. And then Sean Raft. Sean is our Chief Operating Officer, or excuse me, he's our Chief Administrative Officer and General Counsel. So Sean's an attorney. He manages our financial consultants, our legal team, our accountants that do our tax and audit. He also manages our fund administrators, and he does all of our compliance with the SEC and with the Opportunity Zone rules and regulations. So these are the 5 partners at Urban Catalyst. Combined, we've done over $5 billion worth of ground up real estate development here in Silicon Valley. You can see the heavy concentration of projects in downtown San Jose. Now, I'm going to switch gears a little bit now. I'm going to talk about our projected investment timeline. This is something that all of our investors always want to know about. Every Opportunity Zone fund, a little bit different. So for this fund, we're raising $200 million. Minimum investment size, $250,000. We plan on a 3-year fundraise. We base those 3 years on, in Fund 1, we average raising $65 million a year. So put that together for 3 years, that's our $200 million. Just so we all remember, here's where you have to pay your taxes on your initial capital gains event in 2027. And then after that 10-year holding period here in 2034, that's when we plan to sell the properties. And that's, of course, again, when we return the majority of the profits. But we do plan on making distributions prior to the end of that 10-year holding period, the first time being in 2026. And this is through what I call our refinance and distribute program. This is really developer 101, because this is something that we do quite often. And that is, we're going to start construction on these buildings here in 2023. They'll be complete in 2025. We'll have them leased up and stabilized in 2026. And when that happens, we go out and we get permanent financing. We take the permanent financing, we use it to pay off the construction loans, and then any excess refinance proceeds, we plan on passing those through to our investors, and that is a tax-free distribution. Our overall goal is to be able to distribute enough money from this fund so that our investors can use that money to pay their taxes in 2027. Right now, we are targeting a distribution of 65% of our investors' initial investment back to them in 2026 as a part of this program. Now, of course, there are no guarantees associated with investing into Urban Catalyst. You have to read our private placement memorandum to understand all of the risks associated with investment, but I did want to show you what our business plan is. By the way, my attorneys always love me to say that, so there you go. After our refinance event, we have these stabilized assets. Those assets will cash flow for the remainder of the hold period before we sell the assets in 2034. And this is also where I like to talk about, what I call the 4th hidden benefit of the Opportunity Zone program. And it's specifically for Opportunity Zone funds that are structured like Urban Catalyst as an LLC. And the way that this works is, we plan on passing through losses as a part of this fund. Obviously, as an LLC, we have that ability. And that's great. Our investors will get a K1. It'll show losses almost every year through the duration of the fund. And that's fantastic. They can use those losses to offset other passive income. A lot of those losses come from depreciation, and I'll explain depreciation a little bit. Anyone that owns real estate typically takes depreciation on their tax returns every year. It's no different here at Urban Catalyst. We just have bigger buildings, and What we do with that depreciation is we pass it through to our investors as passive losses. And as I mentioned, they can use it to offset other passive income, or if they can't, that's fine too, because that depreciation, that'll accrue over time and carry forward. And it carries forward forever, so you can always use it in the future. Now, here's where that fourth hidden benefit comes in. And that is, typically when an investor owns real estate and they sell that real estate asset, the government makes them pay back all of that depreciation. Specifically for opportunity zone funds, you don't have to pay back the depreciation. There is no depreciation recapture. So all those passive losses that you've accumulated over time, you get to keep them, at least the ones from depreciation. And also what happens when we sell the asset is those passive losses convert to active losses. And so moving forward, investors are able to use those active losses to offset things like ordinary income, which is great because ordinary income, typically a much higher tax rate. So here's how all of this is put together, just to give you a little bit of a recap. Investment period is 3 years. Here's where we make tax-free distributions from our refinance event. After that, we have cash flow, which is tax-free because it's a return of capital once you get basis here in 2027. And then, of course, when we sell the assets, not only is there no depreciation recapture, but there's no taxes on federal capital gains. So just overall, a well-rounded program. Last thing I want to talk about, here at Urban Catalyst, we have a bonus units program. This was really popular in our first fund, so we continued it here into our second fund. The way that this works, if you invest into Urban Catalyst, what you're doing is you're buying our units. Of course, you're paid out based upon the number of units that you own. We do this in 3 ways. The first is our time incentive credit. Time incentive credit, this is to reward investors for earlier investment. You can see here we are in November, 6.25% bonus units. You can see it goes down every month throughout the fundraising period. And what this means is if you bought, say, $100 worth of our units today, we'd give you $106.25 worth of our units. Second way we give bonus units, this is our multiple ventures program. This is if you were an investor in our first fund, where it's a loyalty rewards program for investing into our second fund. And then finally, our volume incentive program. This is to reward investors for more investment. You can see our minimum at 250,000, 0%. Start getting bonus units at 300,000, going all the way up to 1.9 million. Of course, these 3 add together to calculate your total amount of bonus units. Also, another nice thing, our volume incentive program, over 10% of our investors that invested in our first fund invested more than one time. So for example, if you did 500,000, now you get 2%, but say next year you have another capital gains event, you do another 500,000, that would bring all of your units to this 4.5% in the volume incentive program. So it's cumulative. Really, that's the end of my presentation, Jimmy. So I'll stop sharing my screen and we can get to chatting.
Yeah, no, tremendous job, Eric. I feel like you've given that presentation at least once or twice before. Very well done. Thank you.
Maybe so.
Thanks for joining once again. We've got a lot of questions, actually. I do want to get you over into your breakout session in a few minutes here, but let's see if we can run through some of the questions here right now. If we don't get to your question, don't worry. The main session here is going to close down for a lunch break for about a half an hour. Eric's going to head over into the breakout session. I would encourage you to join him over there if you have any questions, or you can kind of hang out here and watch my screensaver go by for 30 minutes. It's up to you. So several questions here. Let's start with the first one here from Chris. Chris asks, hey, Eric, are you open to doing OZ development deals in Oakland as well? Lots of great opportunities to share.
So by the way, I love the city of Oakland. Prior to starting Urban Catalyst, I was the president of Zarsh in America. We're joint venture partners on the Brooklyn Basin Master Plan, which is a 3,100 unit development on the Oakland waterfront, 64 acres of property. Love that project. That whole project's in the opportunity zone. That was before opportunity zones really were a thing. But big fan of Oakland. This fund, we're really just focused on downtown San Jose, so we're not planning on expanding into Oakland.
All right. I got a similar question from Matthew and from Jennifer. They ask, with more people working remotely, is there going to be a demand for more office space? Jennifer worded it as, with the trend toward hybrid work environments emerging, have you taken into account the reduced demand for office space? How has that affected your projections? But what are your thoughts there?
Sure. So Lots of statistics out there showing that we don't really have a reduced demand for office. I mean, there was somewhat of a pause during the heart of COVID, but we're not, say, losing market share to sublease space anymore here in the Valley. If I did want to talk about it, I could go on and on, but I think a personal story is probably better. We had an investor who contacted us from Netflix, and this is when he was, thinking about investing before he invested. And he said, Erik, I'm worried about office space, hybrid work. Netflix just told me that I'm going to be working from home indefinitely. In fact, they sent me a box with all of my stuff in it. And that worries me. And frankly, it kind of worried me a little bit too. I mean, Netflix has come out publicly as they want everybody back in the office as soon as possible, companies. And so I called my friend who works over in HR at Netflix, and I said, hey, are you guys forcing people to work from home? I mean, are you going to be subleasing space or not releasing, or what's going on? And he said, well, yes, we are forcing people to work from home, but no, we're not, getting rid of space. We've hired so many people during the pandemic that even bringing people back on a hybrid work schedule, we're not going to have enough space for everybody. So we've identified folks that we think can successfully work from home, and we're going to force them to work from home really until we get more office space to bring them in. And so we've seen that happen at a number of different companies. You see it once and it might be a coincidence. We've seen it several times, kind of more of a trend.
Gotcha. All right. Well, what about Terrence here? We'll get to his question. Terrence asks, have any of your past projects, or do you have any future projects at Urban Catalyst that are focused on affordable housing?
So the answer is we build affordable housing into some of our projects based upon the requirements of the city of San Jose. We also pay fees to the city, pretty significant ones, for the creation of below market rate housing, but we are not below market rate housing developers in general. And although there are a couple of opportunity zone funds that have done some twists and turns to be able to build below market rate housing, the two programs don't really overlap a whole lot. I mean, our biggest benefit is we give tax-free profits. The creation of below market rate housing intentionally has no profits, so don't quite go together.
Yeah, they do get conflated oftentimes, affordable and with OZs, but they are two separate programs. What do we got in time here? Let's go a couple more minutes here, and then we'll get you off into your breakout session. Let's see. An anonymous attendee asks, what are the fees of the fund? What's your fee structure look like, Erik?
Sure. So we have a pretty standard fee structure at the fund level. We have a 2 and 20, so 2% management fees, an 80-20 split of profits really on the back end after our investors receive all of their money back, plus a 6% return per year. We also have pretty typical developer fees. I mentioned we're not just fund managers, but also developers. It's also kind of nice, the transparency. You get to see what our development fees are. Most of the time you invest into other funds and they're paying developer fees, but you don't know what they are. One of the big benefits from our fees is what I call the no double promote. Typically when a fund invests into a project, the developer of that project is going to be getting, a promote, sort of like our 80-20 split at the fund level. The developer is going to be getting that at the project level. We have no promote at the project level, only at the fund level. So no double promote.
Okay, that's good to know. George asks, and I think he's referring to the Icon Echo project. What is the average apartment rental rate?
Sure. So for Class A apartments here in downtown San Jose, it's somewhat of a range between $3.75 a net square foot per month and $4.25 a net square foot per month.
Let's see, anonymous attendee, and we'll wrap up here after this question. If the property was already acquired, what is the price to fund 2 investors for the land? Is the fund making a profit, or is it contributed at cost?
So the answer is it's contributed at cost. And we have acquired 2 of the 4 parcels associated with the project. We're in contract on the other 2. We close escrow on the 3rd property next month, and we'll close escrow on the 4th property in December of next year. Obviously as developers, we prefer long-term option contracts to close on property because we don't have to allocate fund dollars for the closing until a later date.
Fantastic. Well, we'll wrap it up there. I'm going to head into a lunch break. The main session is going to be in a lunch break here for the next 30 minutes or so. In the meantime, please do head over to the breakout session. I've just posted a link to that breakout session in the chat. So if you click the chat icon at the bottom of your Zoom toolbar down there, you'll have it pop up. It's the most recently sent message that link right there. Erik, you should head over there now. I know Chris Cooley has it open and he's ready for you. And I'll see you on the other side, Erik. Thanks again for
Jimmy,
participating on Losing Tuesday.
always a pleasure participating. You have a great program and good to see you.
All right. Thanks, Erik. Take care.